Here we have the completed amortization table for FirmA. Please note that the values are slightly different, again due to accuracy in calculating the bond value at the beginning of the period. For this table, I used the formula instead of present value annuity and present value tables. You can see at the very bottom, there is only 1 cent variance from the nominal value. Again, if you use table, it is still not wrong. At the end, the variance will be reconciled. So for this table, we can see that the beginning amount is at 1,070,235 ringgit 82 cent, which is at premium. What we want is the value to return to its nominal value at the end of the period. And from this table, we have achieved that. Now let me show you how we record the changes throughout the period. For that, pay very close attention to the figures of interest expense, amortizations of premium, and coupon payment for year 1, year 2, year 9, and year 10. When we issue the bond, we receive the amount paid by bondholders, so we debit bank account with the initial value calculated. We know at maturity we will need to repay the bondholders an amount equivalent to the nominal value of the bond, an obligation to pay, so we need to credit bond account 1 million ringgit, the nominal value. This, of course, not enough, since we receive more than 1 million ringgit. Therefore, we need to also recognize the excess amount as premium from bond. So we credit premium bond account with the excess amount. At the end of period 1 or year 1 for this case, we know that we need to pay a coupon amount of 80,000 ringgit, so we credit bank account 80,000 ringgit. And we also know that we need to recognize the interest expense and reduce the amounts of premium. So we debit bond interest expense account and debit bond premium account. The values for these two accounts can simply be taken from the previous amortized cost table that we prepared. Similarly, in subsequent periods, for example period 2, period 9, and 10, we need to record the payments of coupon to bondholders and recognize the bond interest expense and amortized premium amounts, all taken from the amortized cost table prepared. We may reconcile the variance of 1 cent in the last payment too, so that we get an exact nominal value in the end of 1 million ringgit. So for the year 10 or period 10, instead, we could have bond interest of 70,654 ringgit and 20 cent and amortization amount of 9,345 ringgit and 80 cent. With this, the total premium amortized will be equivalent to its original amount at inception, thus the account will be 0. At the end of period 10, that is when the bond is mature, we also need to repay our bondholder the amount equivalent to the nominal value of the bond. So we credit bank account 1 million ringgit and debit bond account 1 million ringgit. At this point, premium account should already be equivalent to 0. So what we are seeing here is the amortizations of the premium amount from its initial value of 70,235 ringgit and 82 cent reduced to 0 by deducting the amount gradually every period or every time we recognize the payment we make to bondholders. Let us now do the same for FirmB. Again, for this table here, I use formula to get a more accurate values. We start off with a value lesser than the nominal value of 935,823 ringgit and 42 cent. This discounted value will then increase gradually to its nominal value of 1 million ringgit by amortizing the discount. The difference here, the effect of reducing the discount amount is that it increases the initial value of the bond from less than 1 million ringgit to approximately 1 million ringgit. Again, we have a variance of 1 cent, and this can be reconciled at the last payment of coupon. So let us look at the journal entries. For that, please pay close attention to the values of beginning amount, interest expense, and amortizations of discount amount in period 1, 2, 9, and 10. Again, when we issue bond, we will record the amounts of cash that we receive. Thus, we debit bank account 935,823 ringgit and 42 cents. We also know that at the end of the bond period, we have the obligation to repay our bondholders the nominal value of the bond, 1 million ringgit. So we credit bond account with its nominal value. So the difference is the discount. So we debit bond discount account. At the end of every period, we know that we need to pay a coupon payment promised to bondholders, so we credit bank account 80,000 ringgit. We need to also recognize interest expense and amortizations of bond discount at the same time, so we debit bond interest expense account and credit bond discount account. All of these values simply taken from the amortized cost table prepared earlier. Again, at the end, we have a variance of 1 cent. So we could reconcile this in the last payment. So instead, we could debit bond interest expense with 89,174 ringgit and 32 cents and credit bond discount account with 9,174 ringgit and 32 cents. This will make the bond discount account to be exactly 0 and leave us with a bond account of exactly 1 million. Finally, the last thing to do is to record payments of the nominal amounts of the bond. So we debit bond account and credit bank account with the nominal amount. Again, what we can see here, the initial discount of 64,176 ringgit and 58 cents is being reduced gradually every end of period to get to nominal amount of the bond. So now we have seen the importance of the amortized cost table to record the changes in bond value and how we get to these values for both bond issued at premium and at discount. So what if we have transaction costs? For transaction costs, the calculation get a bit complex, and we do not want to really get into the calculations of how we amortize it, simply because it is complicated, and we know a system could accurately calculate it for us. With that note, I will show you an example with amortized cost table ready. Just focus on the journal entries, okay? Let us use the same example as before, but this time we have additional costs, transaction costs of 45,000 ringgit. So here we have FirmA. We know that FirmA issued its bond at a premium, and for this case, we have additional transaction costs of 45,000 ringgit. Therefore, when the bond is issued, we do the necessary journal entries. What we can see here, there is additional accounts, the deferred transaction cost account, and a credit in the bank account for the payments of the transaction costs. This simply means the transaction costs that we paid when we issued the bond will be part of the bond value, thus deferred to be recognized as part of expense at a later date, basically at the end of each period when we recognize bond interest expense. Now let us look at the amortization of premium and transaction costs. For illustration purpose, on how it should work, we will use straight line method for the amortizations of premium and the transaction costs. Please bear in mind that straight line method, as simple as it may be, is not allowed in the calculations of amortization costs. So if we were to use straight line method to calculate the annual amortizations of the premium, we will get an amount of 7,023 ringgit and 58 cents every period. For amortizations of transaction costs using a straight line method, we will get an amount of 4,500 every period. Now, since the transaction cost has actually been taken into consideration when calculating the bond value, the effective bond interest expense will need to include the transaction cost as well. So the interest expense will be the net amount from the coupon payment, the effective interest, as well as the transaction cost. Therefore, for this example, we will have a total interest expense of 77,476 ringgit and 42 cents every period. So if we were to draft the journal, it will be like debit bond interest expense with the calculated amount including the transaction costs, debit bond premium account to amortize the premium, credit bank account with the promised coupon amount, and credit deferred transaction cost account to amortize the transaction costs. Just to show the difference for bond issued at discount, here we have Firm B. Similar with Firm A, when we issue bond, everything else the same, just that we have additional accounts, a credit in bank account for payments of the transaction costs, and a debit in deferred transaction cost account of the total amount paid. Using straight line method, we divide with 10 years bond period for discount amount and transaction costs. At every end of the period, we will have bond interest expense of the net amount of coupon payment, effective interest expense, and transaction costs. Then we need to amortize the discount and amortize the deferred transaction costs, as well as coupon payment of 80,000 ringgit. So that is how the journal entries look like if you were to use straight line method, which is not allowed. But we simply want to see the overview of how transaction costs and discount are amortized together. Now, using the same example, bond issued at discount for Firm B, I want to show you how to amortize both discount and deferred transaction costs using effective interest. So we know that the total amounts of discount and deferred transaction costs is 109,176 ringgit 58 cent, and this amount is used to calculate the bond value. Now, the system of a financial software will determine the amounts of amortized discount and deferred transaction costs at every end of period. But if you were to do it manually, perhaps the best way to explain it is by determining the percentage for each portions of discount and transaction costs. For example, we have a total discounts of 64,176 ringgit 58 cent, and this amount make out approximately 58.78% of the total discount and deferred transaction costs. And for transaction costs, the amounts of 45,000 ringgit make out approximately 41.22% of the total discount and deferred transaction costs. Here is the table of amortized costs for bond issued at discount with transaction costs. This table has been prepared using formula to get to a slightly different effective rate since we include transaction costs. Again, given the value of bond, transaction cost is already included in the value. Thus, not only we need to amortize the discount, we also need to amortize the transaction costs. So here we have additional column for the amortizations of transaction costs with the allocations of 41.22%. and the portions of amortizations of discount at 58.78%. So the total interest expense from the effective interest rate amounted to 86,930 ringgit and 11 cent, and when deducting the coupon payment from it gives us a balance of 6,930 ringgit and 11 cent. This balance will then be allocated between amortizations of discount and amortizations of transaction costs using the percentage determined earlier. 58.78% of the total amortizations amount gives us 4,073 ringgit and 68 cent for the amortization of discount, and 41.22% of the total amortization gives us 2,856 ringgit and 43 cent for the amortizations of deferred transaction costs. To illustrate the journal entries, please focus on values of interest expense, amortizations of discount, and amortizations of deferred transaction costs for period 1, 9, and 10. Again, for this amortized cost table, there is a variance of 13 cent at the end, and this can be reconciled during the last payment made to bondholders. When we issue bond, the journal entries are the same. We need to recognize the amounts of cash we receive from bondholders and the transaction costs that we paid for the issuance. Then recognize the bond discount and deferred transaction costs. And finally, recognize bond as financial liability since we have the obligation to pay the nominal amount at maturity. For year 1 coupon payment, we recognize the bond interest expense, the fixed payments of coupon of 80,000, and amortizations of both bond discount and deferred transaction costs. Every end of period will be the same. Taking the values from the amortized cost table prepared earlier, to reconcile the variance of 13 cents, we might want to adjust the last payment to get to the exact amount of bond at its nominal value. This 13 cents can be allocated to both amortizations of discount and amortizations of deferred transaction costs using the percentage, approximately 7 cents for amortizations of discount and 6 cents for amortizations of deferred transaction costs. So instead, we will have 96,020 ringgit and 52 cents for bond interest expense, 9,417 ringgit and 45 cents for amortizations of discount, and 6,603 ringgit and 27 cents for amortizations of deferred transaction costs. And finally, at maturity, we also recognize the payment made for the nominal value of the bond. From here again, we can see the amortizations of both discount and deferred transaction costs gradually to get to the nominal value of bond at 1 million ringgit. So that is how we do the journal entries for bond, either issue at premium or discount, and recording the changes in values throughout the period of the bond. Please replay the video later if you think you might miss something. In terms of derecognizing the financial liability, in general, we know that we need to derecognize an item when the item is no longer exists, either asset or liability. In this case, for liability, we are talking about obligation. Thus, if the obligation no longer exists, we need to derecognize the liability. This can happen when the contract that gave rise to the obligation has been discharged or cancelled or simply expires, like the bond at its maturity date. An obligation can also be eliminated due to cancellation and discharge. This means that the financial liability has not reached expiration date, or, in the case of bond, it has not reached the maturity date yet. So definitely we are left with a net bond value that is not equivalent to its nominal value. Therefore, it will give rise to either a loss or a gain when we derecognize it. For that, the standard requires that the gain or loss be recognized in profit and loss account or the income statement when the financial liability is derecognized. An example of the situation is an early retirement of bonds, that is, we make payment in full to bondholders not at maturity. Perhaps because we no longer need the cash or we no longer want to commit to pay a coupon every period. To illustrate that, let us look at this scenario. The example is the same as before for Firm A and Firm B. However, we now assume that bond issued by Firm A is callable bond, which means that we, as the issuer, can call back our bond whenever we feel necessary, before its maturity. For this scenario, we refer to the amortization table for Firm A without the transaction costs. As for Firm B, it also wants to retire its bond earlier than its maturity. Now say for example that the two firms wanted to retire their bonds at the end of year 4 or period 4. Firm A called its bond at 101%, while Firm B purchased its bond from the open market at its fair value as at the end of year 4 or period 4. So for Firm A, it redeems its bond at 101%, thus giving us the value of redemptions of 1,010,000 ringgit. This is the amount that Firm A need to pay to its bondholders, which is 10,000 higher than the nominal value. For Firm B, it redeems at fair value at the end of year 4. Thus, we need to calculate the bond fair value as at that date using the same formula to determine bond price at inception. That means at the end of year 4, the bond still have 6 number of payments of annuity and payments of nominal amount 6 period later. This gives us the amounts of 955,172 ringgit. This is the amount that firm B will be paying to its bondholders, which is 44,828 ringgit, lower than the nominal value. If we refer to the amortization cost table for firm A, at the ends of year 4 or period 4, the carrying amounts of the bond is 1,047,665 ringgit and 40 cent. The carrying amount is actually higher than the amount that we need to pay the bondholders at 1,010,000 ringgit. Therefore, we actually has a gain of 37,665,000 ringgit and 40 cent, since we are paying a much lower amount than the carrying amount of the bond. The journal entries will then be derecognizing the bond at its carrying amount together with the premium, recognize the payment to bondholders of 1,010,000 ringgit, and recognize the gain on called bond of 37,665 ringgit and 40 cent. If we refer to the amortization cost table for firm B, at the ends of year 4 or period 4, the carrying amounts of the bond is 995,140 ringgit and 81 cent. The carrying amount is actually lower than the amount that we need to pay the bondholders at 955,172 ringgit. Therefore, we actually has a loss of 31 ringgit and 19 cent, since we are paying a bit higher than the carrying amounts of the bond. The journal entries will then be derecognizing the bond at its carrying amount together with the discount, recognize the payments to bondholders of 955,172 ringgit, and recognize the loss on early retirement of bond of 31 ringgit and 19 cent. So there you have it, all the relevant journal entries for early retirement of bonds. We are now done with the calculation and journal entries for bond, at least those relevant in this course. Before we end, just to highlight a couple other types of bonds. First, convertible bonds. It simply means that the bond, a liability, has the option to be converted to shares and equity at a certain ratio depending on the market value of shares and the fair value of the bonds. This is different from a redeemable bond or callable bond, where no conversion is offered but the bond can be redeemed or called at a date earlier than its maturity. For convertible bond, it does not mean that it must be converted to shares, but it is just an option. A bondholder may or may not exercise that option. This option will definitely change the fair value of the bond at inception, usually at a higher value, since there is an option for bondholders to own the firm shares and become partial owner of the firm. The downside of this is, the option will only be valuable if the market value of the share is at its high end rather than low end. However, nobody knows what will actually happen in the future. Bondholders might pay a higher bond price at the inception due to the option, but end up not exercising the option if the value of shares of the firm is not encouraging or the performance of the firm keep decreasing over the years. It is all about taking risks. Are you ready to take that risk? If yes, then perhaps it is for you. Otherwise, you might want to just stick to ordinary bond. Another type of bond is bond with warrant. Now both convertible bonds and bond with warrant actually give the same option, that is to own shares of the firm. However, for warrant, it is actually detached from the bond and it offers to own the firm shares at a fixed price. For convertible bond, bondholders do not need to pay any extra money to own the shares, but they will not get the nominal value of the bond at its maturity, as it has been converted into capital for the firm. For bond with warrant, bondholders will receive the nominal amount of bond at its maturity, and it can use the warrant to have the rights to purchase the firm shares at a fixed price, so they need to pay a certain amount to own the shares. But if the market price of the shares is actually lower than the fixed price, Bondholders will definitely not use the warrant and simply be purchased from the open market if they want to. Some companies prefer to issue bonds with warrant to negotiate the coupon interest. Basically, it could offer a much lower coupon rate if it has a warrant with the issuance of bond. Now, since this warrant is actually detached from bond, the recording for warrant is also separated from the recording of bond. Whenever the warrant is redeemed, the fund received from this warrant will be transferred to share capital account together with the amount of cash received from issuing the shares for bondholders. If the warrant is not redeemed by bondholders, the fund will be transferred to retained earnings. You may read more about bonds and rating of bonds on the internet. You will also be discussing this and other types of financial instruments in your finance courses. Alhamdulillah, we are now done with bond as an example of financial liability. The discussion is rather long, so please replay the videos if you think you missed anything. And you can always post questions in the forum if you need more clarification and confirmations on what we have discussed. Our next discussion will be on borrowing costs under MFRS 123. As always, please have a read on this. Thanks for your time and attention. I will see you inshallah in the next video. Wassalamualaikum warahmatullahi wabarakatuh.